Well, I've been talking about the fact that maybe it was time to take a little money off the table. We talked about that cash is not always trash. Sometimes it's really, really nice to have some cash on the side that you can deploy if you see an opportunity, or if things deteriorate, you've got this extra cash as a buffer for yourself. I've been talking about the fact that trees don't grow to the sky, and we've had a very, very good run in the stock market. Now, at that point, we talked about the fact maybe you want to reallocate some of your money and take it out of one asset class and put it into another. And let's explore that a little further. And let me talk about why what we're seeing. Remember, we have a couple of charts and our models that are telling us what we think is going to happen, what is going to happen. Let's talk about why. We're talking about the fact you can see this bubble. Now, this is coming out of the Federal Reserve electronic data. It doesn't get much more authoritative than that. So this is actually coming right out of the Federal Reserve. And you can see this big bubble of liquidity that was put into the marketplaces. Now, this little gray bar talks about the recession we had. Now, that was a very short recession, but it was vicious and it was deep, and it affected virtually everybody. It did have some ramifications. So the government put out $6.3 trillion right here in the second quarter of 2020, and you can see all the reserves and all the bank deposits that got into the economy. And here they are. And now you can see as they get coming through and we're going in, the economy is starting to bubble again, and you're starting to see in 2021 they're being spent. Now, there wasn't any additional reserves put in. We didn't have any more stimulus. Now, you had a lot of stimulus. $6.3 trillion, let me tell you, is a lot of stimulus. And that was stimulated here. And of course, it got spent. And here we go back into 2021, and we start getting into a normal market. Now, you can see that they just did some more stimulus, and you can see it popped up just a little bit. Now, we're going to watch that, but this caused inflation. Look at all the money that came into the economy, and it changed things. Now, you've seen the labor. So if you were making $12 or $14 an hour before, well, you're not going to go back to making $14 when you get $20 an hour, because we've had labor shortages, and of course, inflation has now been ignited, and it's become a virtuous cycle. So we're starting to see that one cause causes another. So as prices go up at the producer price index, and we saw that coming. We saw that coming a long time ago. And of course, it races it through the whole chain. And we go back to a new reality. You know, once you start making $20 an hour, you're not going to go back to making $12. So that's just part of the new reality. So let's go to my next slide and let's discuss this even further. Now, we've been talking about the fact that you can see this bubble. Look at this big, gigantic increase. Now, this is where we saw the PPIs come out, and we saw the PMIs came out. We're well over 60. Now, you know, when you have the Purchasing Managers Index, the PMI, when that's running around 52, 54, 55, it's a good world. Everything is doing well. It's above 50, means that the economy is expanding. And of course, it's expanding at a very sustainable rate. Now, this expanded at a rate that was not sustainable. It got up to 62, 63, 64, 20 or 30% more than what we normally see. And of course, it has slowed down. Now, it is slowing very, very slightly. It contracted actually 0.3%. Not much, but we're watching it. Now, my personal feeling is that this is going back to a more sustainable level. You can see that it's starting to level out here. Now, if it starts breaking down and goes down below 50, then we're going to be concerned and say, well, the recession's coming in. At this point, I don't see any recession, but I do see a cooling economy. And you can see from the previous slide, we had all this liquidity had to go somewhere. People were buying and spending. The stock market was exploding. You had all kinds of things going on. People were a little pent-up demand from a recession, and people were out spending. And you can see that. So it's cooling down again, just like the prior liquidity bubble. And I think it's more at a sustainable level. Let me go to my next slide, and let's look at that. Now, also, we've been talking about the fact that we're probably pretty close to full employment. Now, we have an awful lot of baby boomers like me that have thrown in the towel and said, honey, it's time to stay home and let's go enjoy our golden years. So a lot of baby boomers came out of the economy. A lot of them are no longer working, and that's put a little stress. There's not as many employees. Remember, on a normal day, 10,000 baby boomers retire. Now, in an abnormal day, there's a lot more than that. And in the last couple of years, we've had a lot more baby boomers that have decided to retire, and that has put some stress on our employment. And it looks like we're coming down to a fully employed economy. We talked about the fact that we had thought we were going to get a lot more employees, around 400,000, and the last one came in at 199. So a significant difference, which means that the economy is cooling. It's coming down to, I think, a sustainable level. But of course, if we make any policy mistakes, we have some changes. We're having some supply chain issues. We're having some issues in China. China is shutting down a lot of their production. They're closing down cities, and that may very well bleed over to us. And if it does, then we're going to keep our eyes on it. That could very well cause a more than just a slowdown. We could go into recession. At this point, I don't see a recession. Oh, by the way, I really need your support. We do this, and it's really, really important that if you like our videos and we bring some value to you, that you give us a thumbs up if you like this, because it really helps with the algorithms. And I'm going to have a call to action. If you want to reach me and you are having some concerns about your retirement, or you'd like to make your life a little better, if you'd like to start getting involved in our asset class, which is the real estate investment asset class, we like small single-family homes that are close to your home, or in one of the major markets. You can hire property managers. You're welcome to reach us and brainstorm with us. You're welcome to have your financial advisor reach us, and we'll all do what's best for you and come up with a plan. We're in the real estate business. I've written a couple of books. I'd love your support with that too, and please subscribe. It really, really helps us a lot. A lot has been made that the real estate asset class, real estate, right, is slowing down. The media made a really big deal that the prices have slowed. Well, let me tell you, they've slowed from 19% to 18.5%. There was such a slight decrease in the appreciation rate. Now, we're talking 18.5% appreciation rate. That is phenomenal. That is absolutely phenomenal. Prices are rising like crazy. Now, we talked about the fact that the stock market could be vulnerable to correction or more than a correction, and you might want to change your asset allocation to different assets. Now, real estate and cash are different assets. So real estate isn't necessarily correlated very well with the stock market. So if the stock market really takes a beating, it doesn't affect the real estate in asset class. And actually, real estate is counter-cyclical. So when stocks start to go down, real estate goes up. It's part of being a different, separate asset class, and that's just what happens. That's why sometimes it's nice to have some cash. So real estate, particularly in the big markets of the United States, Florida, Texas, and Arizona, is just going crazy. Now, there are pockets of the United States that aren't doing so well, and everyone knows what those are. California is struggling. Now, it's a great marketplace. A lot of people leaving California. $8.8 billion in tax revenue left California. So California's not going to get that money to run the state. Here in Arizona, we got over $2 billion of that. So that really helped us out. And what's going to happen, of course, in California is that they're going to have to raise taxes, which is then going to force more people out because the taxes are going to go up. And it's pushing people here to Arizona. So the big markets like Texas, Florida, and Arizona are attracting people. We're hearing people leaving Seattle. They're leaving Portland. They're leaving Chicago, leaving New York, Minnesota, Wisconsin. So they're going to these great markets, and it's really forcing prices up. And we are seeing prices rise here in Metro Phoenix like crazy. What a great market for you to be in. I'm going to have a call to action that you need to do something about this. You need to get involved, particularly if you're my age and you maybe have a little deficit in your retirement money, you may want to conservatively and make sure that we never jeopardize the asset. But this might be a really, really good place for you to be. We've been talking about my real estate cycle, and I'm going to tell you that we're probably here. So this is the accumulation phase. We've been in that for the last couple of years. Really, when just as the recession was hitting and came into the first quarter of 2020, we exploded, and that would have been the accumulation phase. We're still in that, so we're still advocating that you be fairly aggressive in adding to your portfolio. Again, they always need the cash flow, and it needs to be economically make sense for you to do that. But this is in the real estate asset class. We think that we still are in the accumulation phase, and if you think prices are crazy now, wait till they get into the explosive phase, and we think that's coming. So this is the phases where you really, really make gains. So we'd like you to be involved. If you want to get involved, please contact us, michael@michaeldeville.com. We're more than happy to discuss. Now, it may not work for you. That's fine. We're not advocating that you put all your money in real estate. Our cycle is showing that we still have lots of time yet. Now, as you know, I've interviewed Charles Nenner for many, many years. We did a live webinar last November, and he was kind enough to allow me to use this slide as a proxy for the real estate asset class. This is Toll Brothers. Now, if you follow Charles Nenner's work, it's very similar to mine. It's a cycle. So we're looking at cycles as to what one of these asset classes have a cycle. We're using Toll Brothers as a proxy. Now, this date you see up here in the upper corner is actually tomorrow. That's when they think Toll Brothers is going to bottom right here. This is the very, very bottom. Charles Nenner expects Toll Brothers to start to recover and start going up. Now, this is the same thing if you look at my slide. We start to see this. We start thinking maybe we're going to be heading into the explosive phase very soon, within the next 2 or 3 or 4 months. And that's going to coincide very, very nicely with the Charles Nenners. Now, Charles Nenner is like one of the best in the world. But this does kind of correlate a little bit and give us a little more confidence in the fact that we think my cycle chart and my model is on target. It's been on target for a long time. But again, this is a great time to talk about the fact that just because it's working now doesn't mean it's going to stay forever. So we want you always to check with your financial advisor, talk with us. But we think these charts are good, but that doesn't necessarily mean they always have to be absolutely positively 100% good. Here's some confirmation. We just literally got this from Zero Hedge. This is the housing units, and look at this. Look at this. Housing is on a tear. It just keeps going and going. These are private units. These are building permits. This is showing what's going on, and of course, this is a long-term chart, but look at how well that's doing. It's just confirming that the asset class of real estate is going to do very well. Now, there's a cycle that's showing this, and also we have a pretty big demographics at the moment where we have population shifts, and that's the why. You can see the two are kind of coming together to answer our questions, and it looks very, very promising. Now, again, these are building permits, existing homes, homes, and multi. But you can see it just keeps going up and up and up. Now, we had a little bit of slightly downturn right before Christmas. Very, very small one, and then exploded back up right along with our charts. It's giving nice confirmation to this. We think this is a very, very good indication that real estate is going to continue doing very, very well. Here we're talking about rental units, and I'm going to tell you we are seeing more people go into rental units and not buying, and that of course is because some are getting priced out of the market. Here in Phoenix, it's very difficult for a first-time home buyer to buy a single-family home. So if you're a first-time home buyer and you're looking to buy VA or FHA or 3 or 5% down, and maybe your credit's not as good as it should be, you've been working on it, and you're just kind of like struggling to get in, because remember, it's hard to get this down payment money together. You got kids, you got sports, you got car insurance to pay for, mortgages to pay for, and it takes a lot of money, and then you need to save down payment. This is sometimes a monumental task, In the meantime, a lot of people rent. Very, very good for us because we're in a rental business. It looks like there's going to be more and more people renting. I'm strongly advising if you've got kids, if you've got grandkids, if you've got nieces and nephews, to help them buy a house. This is going to make a huge difference to them down the line. Every one of our surveys from the National Association of Realtors, they show you that those people who own their own home have 10 to 20 times the personal wealth than someone who doesn't. So this is a very, very good thing that you can help them do. And again, our charts are showing the same thing, that we're getting multifamilies coming out. We're getting some single family permits. Now, the problem with single family is a lot of the new construction is not in those big markets. And they are in Phoenix, Texas, and Florida, but that's really where the housing pressure is. We need to have more and more. They're trying, but we cannot build enough units here in Phoenix, Arizona to accommodate all the people coming in, and it is putting enormous pressure on our rents. And as the price of homes go up, price of rentals going up right at the same time, and that delta in between is our cap rate that is staying very, very consistent. So it shows to us that we have a very, very healthy market. Let me go to my next slide. Here's my concern. This is a real valid concern, is that if you do not have real assets in your portfolio, particularly if you're going to be a baby boomer, then inflation is going to destroy your portfolio. If you're in bonds, you really need to talk to your financial advisor. If you're in fixed income, you really need to talk to your financial advisor and see what you can do. Now, there are things, if you're retired, we can really help with some of that. We'd like to partner with your financial advisor. You're welcome to call us. Reach us here in Phoenix. We have contacts all across the country, but of course, Phoenix is probably one of the number one markets in the world. Be a great place for you to buy some things. We're pleading with you to get at least 2 rentals in your portfolio to help with inflation and protect your purchasing power, because the December inflation just came out and it is going crazy. We see inflation may slow down. I don't see it going away. I just don't see it going away. It is really at a tear. If you've seen some of our other videos, you'll see that we set a record that had been held since 1975. Last month, we went higher than 1975. And in the 70s, we had double-digit gains in real estate. I don't know if that's what's going to happen now, but it's very, very similar to what we saw in the 70s. We saw oil rising in the 70s. We have that now. If you are on a fixed income, you are going to get left behind. Housing and real estate is a separate asset class, and it adjusts to inflation. It's one of the greatest inflation hedges you can possibly have. Talk to your financial advisor. Call us. As a call to action, call us. We're more than happy to work with you to find you a very, very conservative property that's going to protect your purchasing power and, of course, put cash flow into your portfolio. This is what we want to do. We want to make sure that you get more income. But inflation is certainly rising. Here's the call to action. We want you to have at least 2 of these properties in your portfolio if you're going to retire. 10 is so much better. If you have 10, your life is going to be absolutely marvelous. It's going to be a really, really good market for yourself. We'd be really, really pleased if that were what happened. But you can find these homes virtually everywhere in the United States. We're loaded with them. We have tens of thousands of them here in Phoenix Metro, and you can buy these. They rent out virtually every single day. It's a call to action. I've been told I'm not being stressing this enough. You need to get at least 2 properties in your portfolio. Call us. You're welcome to reach me at michael@michaeldeville.com. These rent out overnight. Just overnight. You're not going to worry. Don't worry that they're never going to rent. They rent out. We have multiple people looking for these. Of course, this is a decades-long trend. This isn't something that's going to be done in 2 or 3 months. We're looking for decades. So please call us. As a call to action for you to get one of these properties. These are very, very reasonable in Phoenix, and they rent out overnight, and we get a nice cash flow, and that cash flow includes property managers, so you don't have to deal with the tenants. You're not going to get a call in the middle of the night that the toilet doesn't work. You're going to call your property manager. He's going to take care of that. They're going to They're going to put tenants in for you. They're going to collect your rents. They're going to do everything that you possibly can. It's very, very reasonable. When we do our calculations, we always include a property manager. We include the cost of leasing, cost of repair. We put a vacancy factor in, so we can give you something as representative as we possibly can for what you're going to receive on a monthly basis. Because you buy a property, you're going to start getting cash flow the very next month. In 30 days, you're going to start getting cash flow. That's what we want to do. Please give us a call, and let's get this going. Let me go to my next slide. Now, this is CYA for me. We are all licensed real estate agents here in Phoenix, Arizona. I'm a real estate broker, but I'm affiliated with West USA Realty. This is their corporate number. You can reach me at 602-942-4200. Call me. We'll do everything we possibly can. Call me at 602-942-4200. Reach me at michael@michaeldeville.com. My very, very best to you.